The finance world was known to be centralized, with banks, governments, and financial institutions controlling money, transactions, and markets. It relied on intermediaries for transfers, loans, investments, and exchanges, often involving delays, fees, and regulatory oversight. There was limited accessibility for individuals outside traditional banking systems until a new digital currency was introduced in 2008 named cryptocurrency. It was created by an anonymous person or a group of people under the pseudonym Satoshi Nakamoto. Satoshi introduced Bitcoin or BTC in 2008, presenting it as a decentralized digital currency without the need for intermediaries like banks. The crypto is short for cryptocurrency, which is a type of digital or virtual currency that uses cryptography for security. Cryptocurrencies are decentralized, meaning they are not controlled by any central authority like a government or financial institution, such as the Federal Reserve or a bank. Instead, they are typically built on blockchain technology. Some of the most well-known cryptocurrencies are Bitcoin, Ethereum, and Litecoin. Cryptocurrencies can be used for a variety of purposes: online purchases, investments, remittances, and even for running decentralized applications, as is the case with Ethereum. Bitcoin, or BTC, was launched in 2009. It was created by Satoshi Nakamoto, who remains pseudonymous. Bitcoin is the first and most well-known cryptocurrency. It is often referred to as digital gold and is primarily used as a store of value and a medium of exchange. Its primary goal is to provide a decentralized peer-to-peer method of transferring value without relying on intermediaries like banks. The underlying technology behind Bitcoin is known as the Bitcoin blockchain. Ethereum, often abbreviated as ETH, was launched in 2015. It was created by Vitalik Buterin and others. Now, Ethereum is more than just a cryptocurrency. It's a decentralized platform that enables developers to build and deploy smart contracts and decentralized applications, or dApps. Ether, or ETH, is the native currency used to pay for transactions and computational services on the Ethereum network. All of this operates on the Ethereum blockchain. Binance Coin, or BNB, was launched in 2017 by the Binance Exchange. Originally, it was created as a utility token for the Binance Exchange. However, BNB has evolved into a multi-use cryptocurrency that now powers the Binance Smart Chain, or BSC. This is a blockchain platform for decentralized applications and smart contracts. BNB operates on both the Binance Smart Chain and the Binance Chain. Ripple, known as XRP, was launched in 2012 by Ripple Labs, which includes David Schwartz, Jed McCaleb, and Arthur Brito. XRP is designed as a fast and low-cost digital payment protocol for international money transfers. Unlike many other cryptocurrencies, XRP does not rely on mining. Instead, it is pre-mined with a supply controlled by Ripple Labs. All of this operates on the XRP ledger, also known as Ripple. Litecoin, abbreviated as LTC, was launched in 2011 by Charlie Lee. It's based on Bitcoin's protocol but with some key differences, such as a faster block generation time and a different hashing algorithm called Script. Often seen as the silver to Bitcoin's gold, Litecoin is used primarily for peer-to-peer payments. The underlying technology is the Litecoin blockchain. Cardano, known by its ticker ADA, was launched in 2017 by Charles Hoskinson, who is also a co-founder of Ethereum. Cardano is a blockchain platform designed for building decentralized applications and smart contracts. What sets Cardano apart is its research-driven approach and a layered architecture aimed at scalability and security. ADA is the native cryptocurrency of the Cardano network, which operates on the Cardano blockchain. Polkadot, or DOT, came onto the scene in 2020 and was created by Gavin Wood, another co-founder of Ethereum. The main goal of Polkadot is to create an interoperable network of blockchains, essentially allowing different blockchains to communicate with one another. This enables cross-chain transactions, making it possible for assets and data to flow freely across various blockchain networks. The technology behind it is the Polkadot blockchain. Dogecoin, or Doge, was launched in 2013 by Billy Marcus and Jackson Palmer. Originally created as a joke based on the popular Doge meme, Dogecoin has since become a widely used cryptocurrency for tipping, charitable donations, and online purchases. It has a passionate community and has gained attention through endorsements from figures like Elon Musk. The blockchain it operates on is the Dogecoin blockchain. Chainlink or Link was launched in 2017 by Sergey Nazarov. Chainlink is a decentralized oracle network that allows smart contracts to securely interact with real-world data, APIs, and payment systems. It connects blockchains with external data sources, making it a critical component for many decentralized finance, or DeFi, applications. The blockchain it operates on is the Chainlink network. Solana, or SOL, was launched in 2020 by Anatoly Yakovenko and others. Solana is a high-performance blockchain designed to provide fast, low-cost transactions. It supports decentralized apps or dApps and smart contracts, and it aims to address scalability issues faced by other blockchains like Ethereum. The blockchain it operates on is the Solana blockchain. What is a blockchain? A blockchain is a type of digital ledger or database that is distributed across multiple computers, often called nodes. It records transactions in blocks, which are linked or chained together in a secure, tamper-resistant way. Here's a simplified explanation of how it works. Each block contains a list of transactions, like the sender, receiver, and amount. Once a block is full, it's sealed with a cryptographic hash and linked to the previous block, forming a chain. This chain of blocks is publicly accessible on some blockchains like Bitcoins, and cannot be easily altered once a block is added, ensuring the integrity of the data. Because of this structure, blockchains are highly secure and decentralized. They do not rely on a central authority to verify transactions. Instead, the network of computers does that work collectively. Here's a detailed explanation of how cryptocurrency transactions are made. First, creating a wallet. Before you can make a cryptocurrency transaction, you need a cryptocurrency wallet. A wallet is a software application that stores your private keys, which you use to sign transactions, and public keys, which is your wallet address that others use to send you cryptocurrency. Private key, a secret key used to sign transactions and prove ownership of the cryptocurrency in your wallet. Public key, the address that you share with others so they can send cryptocurrency to your wallet. There are different types of wallets: hot wallets, which are connected to the internet, making them easier to use, but potentially more vulnerable to hacking. Cold wallets, which are offline wallets such as hardware wallets, and are more secure but less convenient for frequent transactions. Next, initiating a transaction. Once you have a wallet and some cryptocurrency, you can initiate a transaction. Here's the step-by-step process for a typical transaction on a blockchain. On the sender's side, initiating the transfer involves selecting the recipient's address. To send cryptocurrency, you'll need the recipient's public address. This could be their Bitcoin address for Bitcoin transactions, Ethereum address for Ethereum transactions, etc. Enter the amount. Specify how much cryptocurrency you want to send, sign the transaction. Using your private key, you sign the transaction. This step proves that you are the rightful owner of the cryptocurrency and have authorized the transfer. The signing process involves creating a cryptographic proof or signature based on the transaction details and your private key. Broadcast the transaction. After signing, you broadcast the transaction to the cryptocurrency network through a node or exchange platform. The transaction data is composed of the sender's address, which is the public key of the person sending the cryptocurrency, the recipient's address, which is the public key of the person receiving the cryptocurrency, the amount of cryptocurrency being transferred, the transaction fee, which is a small fee that is paid to incentivize miners or validators, and the signature, which is a cryptographic signature created using the sender's private key. Next, validation and mining, which involves proof of work or proof of stake. Once the transaction is broadcast, it is picked up by miners or validators depending on the consensus mechanism of the blockchain. Proof of work, used by Bitcoin for example, involves miners competing to solve complex mathematical puzzles. The first miner to solve the puzzle gets the right to add the new block of transactions to the blockchain. The miner who successfully mines the block is rewarded with newly created cryptocurrency, like new bitcoins, and transaction fees. Proof of stake, used by Ethereum 2.0 and others, involves validators being chosen to propose and validate blocks based on the amount of cryptocurrency they stake or lock up as collateral. Validators verify transactions and confirm the block to be added to the blockchain. Instead of mining, it's more energy efficient and based on ownership of the cryptocurrency. Next, block creation and consensus. After a miner in proof of work or validator in proof of stake confirms that the transaction is valid, it is grouped with other transactions into a block. The block is then added to the blockchain. The blockchain is a public ledger that stores all transaction data. Each block contains a list of recent transactions and a reference to the previous block, creating a chain of blocks. The consensus mechanism is the process by which the network of nodes or computers agrees on the validity of transactions and the state of the blockchain. Next, confirmation and finalization. Once the block is added to the blockchain, the transaction is considered confirmed. The number of confirmations typically increases with the number of blocks added after your transaction, making the transaction more secure and harder to reverse. For example, Bitcoin transactions often require 6 confirmations to be considered final. Finally, on the recipient side, once the transaction is confirmed, the cryptocurrency is transferred to the recipient's wallet. The recipient can see the funds in their wallet and use them for future transactions. The recipient's wallet is updated, showing the new balance after the transaction. How is crypto different from any other currency? Traditional currencies like the US dollar or the euro are fiat currencies. This means they are issued and regulated by a government or central bank, and their value is backed by the economic power of that government. Here are the key differences between cryptocurrencies and traditional currencies. Decentralization cryptocurrencies are not controlled by any central authority, like a central bank. This makes them less susceptible to government interference or inflationary policies. Digital nature. Cryptocurrencies exist only in digital form. You can't hold them physically like cash, but you can store them in digital wallets. Supply and demand. Many cryptocurrencies like Bitcoin have a fixed supply. Bitcoin's supply is capped at 21 million coins, which contrasts with fiat currencies, which can be printed at will by central banks, leading to potential inflation. Security. Cryptocurrencies are secured through cryptographic techniques, and their transactions are recorded on blockchains, which are very difficult to alter once confirmed. Global accessibility. Cryptocurrencies can be sent across borders quickly, without the need for intermediaries like banks, and with potentially lower fees. How is this going to impact our future? The impact of cryptocurrencies and blockchain technology on our future is still unfolding, but there are several ways it could significantly change how we interact with money, governance, and technology. Decentralized finance or DeFi cryptocurrencies enable the creation of financial systems without traditional intermediaries like banks. This could lead to peer-to-peer financial services such as lending, borrowing, and trading, potentially reducing costs and increasing access for people in underbanked regions. Improved security and transparency. Blockchain technology's transparent, immutable nature could improve security in various sectors, such as voting systems, healthcare, and supply chains. Transactions on the blockchain can be verified by anyone, making fraud harder to commit. Financial inclusion. Since cryptocurrencies are accessible to anyone with an internet connection, they could be a tool for financial inclusion, especially in parts of the world where people don't have access to traditional banking services. Smart contracts and automation smart contracts, which run on blockchains like Ethereum, can automatically execute actions when certain conditions are met. This could revolutionize everything from real estate transactions to intellectual property management, reducing paperwork and human error. Disruption of traditional industries. Entire sectors like banking, insurance, and real estate could be disrupted as blockchain technology becomes more widely adopted, potentially cutting out middlemen and streamlining processes. New economic models. The rise of cryptocurrencies could lead to the creation of entirely new economic models, such as tokenized communities or DAOs, decentralized autonomous organizations, where decisions are made collectively by token holders. Challenges and risks. There are also potential risks. Regulation. Governments may impose stricter regulations on cryptocurrencies to prevent money laundering, tax evasion, or fraud. The regulatory landscape is still uncertain in many regions. Environmental concerns. Some cryptocurrencies like Bitcoin require significant amounts of energy for mining or validating transactions, which has raised environmental concerns. Market volatility. Cryptocurrencies are often extremely volatile. While this can offer high returns, it can also lead to significant losses for investors and create instability in the broader financial system. As fast as the financial sector is changing, cryptocurrency and blockchain technology are still in their early stages, but they have the potential to radically transform multiple sectors by enabling decentralized systems, improving transparency, and offering new financial services. The future impact will depend on how governments, industries, and individuals adapt to and regulate these technologies. In the long term, cryptocurrencies could significantly change how we perceive money, value, and even trust in institutions.